Good afternoon, everyone. My name is Bryan Roof. I'm excited to be here today and to help share an economic analysis with our group. To get started, I'd like to introduce my team members and set the agenda for us. So joining me today are my team members, Prerna, Petra, Omar, Ian, and Kevin. And we are with the economic analysis team here at RTP Capital Management. The purpose of our meeting is to look at country level economic guidance and hopefully to help inform investment strategies and decisions as we go forward. There are several regions, international regions that we've studied along with specific countries. We look forward to sharing some of that information with you. So to get started, the first area we looked at was Southeast Asian nations, specifically Sri Lanka. Sri Lanka is a nation with nearly 22 million people with a world GDP ranking of 74th, and that moves between 74 and 76. Its largest GDP component is the service sector. Sri Lanka is a nation built on tourism. Um, Sri Lanka, and it's important to understand that Sri Lanka in 2022 experienced a financial crisis. So the COVID-19 pandemic that came in 2020 had a significant impact on their economic health and well-being. That was compounded with losing access to several international financial markets and poor policy decision making. What happened is that in 2022, their foreign reserves were completely depleted. Their economy contracted significantly. Inflation rose almost immediately, and their currency depreciated over 80% almost instantaneously as that reset. So as a result, Sri Lanka defaulted on some of their international debts. These graphs which we've pulled down from IMF indicate this. You can see on the left the reduction in total foreign reserves leading into 2022. And then on the right, the government gross debt that just skyrocketed in comparison to other Southeast Asian nations. So they were in some troubles in 2022. Now let's jump into where we're at today. So the GDP. As we mentioned, their GDP was really significantly impacted in 2022 with their financial crisis, and some of that impact carried forward into 2023. However, we're beginning to see some improvements. So recently, Sri Lanka has recognized growth in all GDP sectors, including the service sector. Employment, as some of the lag indicators that we're looking at, employment has increased, specifically in the service, but also in the manufacturing industries. So the current rating for GDP is a -1, but we have put the short-term rating 2 points higher at 1 with an asterisk, really pointing out in this spread graph that their GDP growth is actually ahead of other Southeast Asian nations, which is promising. When we look at inflation, Sri Lanka experienced hyperinflation, skyrocketing nearly 50% as indicated in this IMF graph at the top compared to other Southeast Asian nations. It was out of control. This had a significant impact on purchasing power, but in 2023, the inflation began to ease. And it's, as you can see in the Fred graph below, which carries it forward a little further in 2023, it has settled down around 16%. Some of the other indicators are indicating that it's likely to hover in the 10 to 14% range. So as a result of this, we do have the inflation at a -2 rating for current, but have improved that slightly for a -1 in the short term. Again, it's better, but not quite in line with other Southeast Asian nations. Some of the indicators are promising, but we need to see what happens. Looking at the exchange rate, again, as you'd anticipate with a financial crisis, the rupee experienced a rapid depreciation almost instantaneously overnight. When their financial reserves ran out, there was no other option but to depreciate the rupee. However, since that time, in 2023, looking at the indicators, the rupee has actually appreciated, not surprising from the point it was at. Lead indicators such as growth in all GDP sectors, reduced demand for imports, and really the agreement to restructure some of their debt is leading to some stabilizing and slight appreciations for the rupee. So for those reasons, their current rating for rupee is -1. Again, it's better than certainly where it has been. And the short term is 0, a slight improvement given these indicators. Looking forward now, and bringing this all into a concise statement, what we're seeing is that Sri Lanka really has moved from a very challenging financial crisis of 2022. It began to improve in 23, and now in 24, it's showing indicators that it's continuing that trend. Most notably within GDP, trending above uh, other regional nations. So you can see our ratings here. Some, if not most, are in the negatives, but those have been improving with time and with the indicators that we've shared with you. There's much more detail here in the sources that you can dive into. And now I'd like to turn it over to my friends to share the rest of our regions and nations with you.
All right. Hi, everyone, and thank you, Perna. I will be discussing the current economic state of Hungary, which is a small country located in Central Europe and is a member of several major international organizations. It joined the European Union in 2004 and the Schengen zone in 2007. The local currency is Hungarian forint, as it's still not a member of the Eurozone. And on the global stage, Hungary ranks 54th in terms of GDP. I rank the country's economy or economic status as neutral, with a stable to moderate inflation and stable exchange rates. However, these rates are not fully aligned with Hungary's larger economic goals. In the short term, we are seeing slight improvements, but not to the extent that would significantly upgrade Hungary's economic scores. But I will go into more details in the following slides. Hungary has faced several significant economic shocks recently, including COVID-related supply chain disruptions, obviously surged commodity prices due to the Ukraine war, and delayed European Union funds. These issues have impacted Hungary more severely than other Central European or European Union countries. Despite signs of recovery, Hungary struggles with fiscal imbalances and elevated inflation. And it has a high integration with economies such as Germany and Austria, but also with Russia and China, which makes Hungary sensitive to regional developments as well. So to focus on GDP, in 2023, Hungary's GDP decreased by 0.9% due to high inflation, high interest rates, and weaker external demand. However, economic activity began to recover in 2024, with GDP rising by an estimated 0.8% quarter on quarter. The current growth rate is comparable to Hungary's long-term historical trends, but despite this recovery, the fiscal deficit and the public debt to GDP ratio remain above 2019 levels. Regarding inflation, so inflation in Hungary has been another critical issue. It peaked at 26.2% in January of last year, and it averaged around 17.7% for the rest of the year. And common external shocks had elevated inflation rates across all Europe, but Hungary was recording a much higher inflation rates due to factors like the war, and the war's impact on energy prices, depreciation of the national currency, inefficiencies in the domestic food and food manufacturing industry, etc. By 2024, inflation had decreased to 3.9%, but the recovery of consumption and strong nominal wage growth are set to limit further decreases. Hungary follows a floating exchange rate policy, so after years of nominal depreciation, now the Hungarian forint is strengthening. As you can see from the graphs, the exchange rate of the Hungarian forint has fluctuated much more than regional currencies, with quite some pronounced spikes of volatility during the financial market stress. In short term, a gradual economic recovery is expected in Hungary as households' purchasing power rises, financial conditions ease. GDP growth is forecasted to reach 2.4% short term, mostly driven by domestic consumption and the falling energy prices, lower inflation, and lower interest rates. This could increase investor confidence as well. However, inflation is expected to remain above the central bank's target of 3% in the short term. The general government deficit is also expected to remain elevated. So to summarize, Hungary is showing signs of economic recovery due to gradual reduction of interest rates and moderate energy prices. But the central bank's careful and patient approach means no major decrease in interest rates is expected in the short term despite easing inflation. And lack of progress in governance reforms could result in persistent challenges and prolonged suspension of important EU funds. So, in my opinion, Hungary's economic and political institutions show quite extractive practices with significant state ownership in key sectors that impedes competition. So that was all for Hungary. If there are no questions or comments, I will now pass on to the next speaker. Thank you very much.